I just got an error on my camera saying that it's exceeded the time limit that I can record. So it's been over an hour. So that's gonna be 1, 2, 3 videos that I'm supposed to have to be both are gonna be extra. Alright, let's look at this, I guess. Oh, my face. Anyways. So yeah, wait, I have to see, I have to watch a guide on like actual futures and like how to actually like trade futures. Like what time frames am I looking at? What am I looking at? How to trade futures. Let's watch a video on this. I've seen this guy, Counter for Beginners, full guide.
I consistently day trade using futures for just 60 minutes every morning, and I'm going to consistently find profitable trades. In this video, I'm going to go through the whole laundry list of things that
Yes, I need this. What are futures, how they work, blah blah blah.
you need to know and understand about futures and how they work. I'm going to just explain the basics of how futures work, how they're priced differently compared to other assets, why they're actually just better than other assets if you ask me. I trade everything, and I find futures to be the best. What's margin, how it works, what's overnight margin, intraday margin, how they're priced, what is the best place to actually trade futures, and we'll go through a lot of other things, and even some tax advantages of trading futures over other assets. And so we're going to start with the basics and slowly build you up. So after the end of this video, you will be able to have a trading platform and understand how futures work and to be able to start executing a trading strategy with it. Now, futures work differently than stocks in many ways, but once you understand them, it's very simple, just like trading a normal stock. If you buy it and it goes up, you make money. And if it goes down, you lose money. For example, though, the big difference is when you buy, let's say, one share of Apple, you can hold that share as long as you want. You own a piece of that company, and it will never expire unless the company goes bankrupt or is taken private. With futures, you aren't actually buying part of, let's say, a company like Apple. You are buying a contract agreement that's value is based on the market it's connected to. So, for example, let's say you buy one futures contract in the oil market. The contract's value will go up when the oil price increases, and it will go down if the price decreases. The exact same way a share price of Apple would go up or down. So when it comes to the practicality of actually trading this, there's basically no difference. But the only thing is the futures contracts expire unlike shares. The length of a futures contract can depend on what market you're actually trading, but generally it's 1 month or 3 months. This is the one reason why futures are a shorter term trading asset. It's not something you hold for a long term. Most people, like me, day trade using them. That's where the real advantage comes into play. The trading platform I'm using is called NinjaTrader. I've been using it for over 5 years now, and one of the nice things is they don't charge you to practice with live trading data right away, which most platforms do. You can check it out using the link in the description of this video or using this QR code. Now technically, when you buy an oil futures contract, you are buying the ability to buy 1,000 barrels of oil at a certain price. That's the nuts and bolts behind it. But in reality, you're never going to do that. You're just using this contract to get leverage of 1,000 barrels of oil. Because this contract actually costs a fraction of the purchase price of 1,000 barrels of oil. But you get the value increase or decrease of those 1,000 barrels of oil. It's the exact same thing as buying a house with a loan. You only put up the down payment for the house, let's say $100,000 on $1 million house, but you get the increase or decrease of the $1 million value of the house. But you're only putting up a fraction of the total value in the down payment. Now in the trading world, that down payment on the house is not called a down payment, it's called a margin requirement. Just think of it like the collateral that you need to put up for one futures contract of, let's say, oil. For example now, if we buy one futures contract of the S&P 500 futures, which is a different futures market, this will take about $500 worth of margin. Your account will have $500 taken away as collateral. But when you sell the contract back, you get the $500 worth of margin back. Now this isn't taking into account the profit or loss that you made on the specific trading token. So when you see the price of the S&P 500 futures trading at, let's say, $6,000, it doesn't actually cost you $6,000 to buy one futures contract compared to, when you buy shares.
Yeah, you can buy as much as you want.
Requirement at the time. Now the market requirement will differ from asset to asset, like oil futures to wheat futures, or from brokerage to brokerage, and time of day. And so let me break down to you each one of those categories. First off, you have what is called intraday and overnight margin. So for example, the US stock market is only open during the New York trading session, which is 9:30 a.m. Eastern Standard Time till 4 p.m. Eastern Standard Time. This is the only time of day that you can trade stocks that are in that market. But futures, on the other hand, are open almost 24 hours a day, 7 days a week. They technically close for a short amount of time after the New York...
Praise the week. Evo nešto snijemo ovdje. Pa hoćemo sutra posle moje škole. Pa eto će vidimo. Ništa, evo imam ja samo malo ovo nešto pogledam pa izvajam čim budem završio. Volim te, čao.
Your session closes and over the weekend, but this is how the intraday and overnight margin difference is made. If you're trading, let's say, the S&P 500 futures during the New York session, when all other stocks are open, in that 9:30 to 4 o'clock window, you only are required to put up the intraday margin, which is generally extremely low, compared to the overnight margin, which is...
Okay, so the first thing I want to do, so I don't forget later, is to get an indicator or something that marks out this thing, and I'll be putting my chart in EST time. Or like New York. What time is that? Sydney, Tokyo. Not sure what time that is. Moscow. London, no. New York, UTC -4. Okay. Okay, so yeah, this makes more sense. So let me get something that marks. So trading zones. What the hell is this? Okay, well, this is pretty helpful, I understand, but I don't need an intraday. I'm just looking for, like, mark. I'm just looking for something that, like, shows me where the fuck it is. What? The hell is this? Man, I just want something to... Time, is there like... Is there a way that I can like... mark this out? What the hell? Fuck off, man. Is there like a... session, I guess? What the hell is this, man? I was looking at the wrong one. Oh my god, I'm so fucking smart. I'll call this intraday. And it is from what, 9? Let me go check. 9:30 a.m. to 4 p.m. I'll make it like, I don't know, white. So this was intraday. What is, okay, so that's from, and I'll make this like, so it's intraday and overnight. So overnight is from 12 a.m. to 9:30 a.m. 00 to 9 a.m. to 9 or 9:30 a.m. to 9:30 a.m. And then this one is from 4 to 00. Right. Yeah. And I'll make them like, I don't know, black. I guess, sure. You can't even fucking see. I'll make it like this color. Right, too. Okay, well now they're marked intraday, and can I make these a little like bigger? I can't fucking see it like at all. Wait till like. Okay, why is it fucked up now? Like what? Okay, yeah, now that actually marks out where my. Okay, nice. Right, so let's see. 9:30.
Just any time the New York market, which is generally extreme.
It's a 9:30 a.m. to 4 p.m. to 4 p.m. And then this is from. There's one from 00 to 9:30, and there is one from 4 to 9:30. Okay. Could I just make it like from 4 to 00? Yeah, okay, that works as well. Okay, well, I'm glad that worked out well. Just don't need either of these. Okay, that's great. I like this one. Okay, that helps a lot. Is there a way that I can make this like a little bit of a lighter color? Like, really like, barely visible, like 10% opacity. This one as well. Just want to be able to see what I'm doing nice. And then we can take that down to like 3%, or 5. And then this one. Not sure if I'm too close to the camera. I hope you guys are not screaming into the microphone. I hope not. Oh my goodness, oh my bosom. Anyways, let's go back.
compared to the overnight margin, which is any time the New York market is closed. So for the S&P 500 futures and really any US-based futures, it's going to cost you a lot more to trade outside of that stock market open window. Now these margin requirements can change based on brokers. Some of the brokers have the more normal margin requirements, which can be roughly 5,000 to 7,000 for the intraday, but other ones like NinjaTrader, which is the one I use, can have low margin requirements for, let's say, the S&P 500 futures. One contract can be $500 worth of margin, which is tiny for how much leverage and potential and profit that it gives you. But for almost all the platforms, the overnight margin is never reduced, which is generally double the intraday margin or around 15,000.
I don't care about this.
Now these are the normal margin numbers. This can actually change when market volatility goes up. Because when the market goes crazy, brokerage over a physical asset, and if you held that close to that date, you always trade the new contract anyway. You'll even do it a couple of weeks beforehand. And what this is called is it's still massive for a small account. And so if you're wanting to start with an account of, let's say, $500 or $1,000, what you can do is you can trade what is called the micro futures. All the main futures contracts have them, and they're essentially 1/10 of the size of the normal contract size. So for the S&P 500 futures, your max loss. Technically, you own one contract of the US futures market, and if the market suddenly crashes, you could lose more than your account or that $500. That is almost never happens. I've never had it happen to me over the 5+ years I've been trading futures, and there's a couple ways you can protect yourself to make sure this doesn't ever happen. The first way is always have a stop loss in place no matter what. Never move it farther away. First off, increasing your potential risk once you're in a trade, because if the market opens and goes against you really quickly, this stop loss will get you out of the trade as fast as possible, not allowing you to lose more than you were planning. Now you can get something called slippage, where the market's moving so fast that even a market order won't get filled at the exact price. This doesn't really happen that often, and in the end, it's not actually that much money that it will slip. You might lose a bit more than you wanted to, but it won't be a crazy amount. The other way for this to happen, and let me show you on a chart real quick, is if you traded and held through the futures market closing and then opening. And so essentially what that would look like is if you entered in, let's say, a buy here, expecting the market's going to go up, and the futures market closes for an hour after the trading day every day. And so you can see here, if you entered in a trade here, the market closed right at this price, and then opened all the way down here. And if your stop loss of, let's say, risking $500 was right here, and let's say your account, is $1,000, and you're only planning to risk a couple hundred here, well, the best price you could have done was all the way down here, which would have been a couple $1,000 worth of loss. And so that's how you could have had an over-exaggerated amount of loss that could theoretically blow your account.
Oh,
so that's
okay.
the biggest thing that I would do is never hold futures into an overnight close, or even over into the weekend when it closes. Basically, when it closes and opens again, that's your big window for having an extreme loss that you can't get out of. And also, this happens a lot because news or, stock earnings will come out right after the market closes. And so when it opens again, and let's say Apple comes out with a really bad earnings report, because Apple's a big part of, let's say, the S&P 500 futures, or if you're trading the NASDAQ futures, it'll make a big drop and a gap like that we saw in the futures contract that you're trading, and you'll take a massive loss. Lastly, the only fees that come with trading futures is generally kind of some kind of routing fee, and then the commissions that the trading brokerage you use. Generally, the routing or trading fees are fixed and will be the same across the board, and then not complicated like options, but it gives you the leverage that options allow. So it's kind of the best of both worlds. You buy
I don't really care about tax advantages. That's not
looks like on
important.
a real chart. And so this is looking at the S&P 500 futures, the ES futures. We're looking at the main contract, not the micro smaller version. This is the full contract. And you can see over here on the left side this is the price movement, and it's going up in 0.25 increments. Sometimes it might jump a little bit more because the market's moving pretty quickly right now, but generally it'll move up by 0.25. And then if I just click right here, buy market at one contract, you can see that the dollar amount is going up or down in 12.25 increments. And if it moves up 1 point in my favor, that'll be about $50. And so you can see, we're looking at a 1 minute chart right here, the dollar movement per price is very, very large. We're trading one contract here, and you can see over this one small candlestick, I'm already up like $200. And so you can imagine if the market just moves up right here, that's probably like $1,000. And this move right here, that took about 25 minutes, with one futures contract would have been probably like $2,000. And so you can see the leverage of that money comes into play massively. This costed me $500 worth of margin, and you can see that I'm already basically up $500. And so the leverage there that you can get on a tiny account to potentially make a huge amount is really, really big with these contracts. But again, you can see on the flip
Yeah,
side,
I mean, as you guys saw earlier, I put in like 10 sell trades with like $100, and I made like 20,000 from it just going down, which was fucking insane.
$100 I was up, it has all of a sudden seemed to start to evaporate, right? And so again, leverage can work against you or for you. And so that's where you want to then go into. If I then just, this is just a demo account, I'm not going to just be goofing around on real money here. If we go into the micro futures, you can see it looks the exact same chart, but if I buy one contract now, it's a tenth of the size. It's going up or down $1.25. And so this is the exact same thing for everything in terms of if you jump into a micro futures contract, it allows you to now start with a super small account, and these movements for a small account are a lot more manageable. Instead of risking $500 for a small swing, which can seem huge, I could put enter in here and put my stop loss down here, and I could be risking $20. And I could, my target could be $30. And so this is how you can start with a really, really small account and then slowly scale, because then, of course, to scale up, it's super easy to say, well, instead of buying one contract, I now want to buy 2 contracts. And, see here, it's number 2 means how many contracts I have, and now it's going up by, $2.50 instead of $1.25 per tick because I have 2 contracts instead of 1. And so you can, that's how it's allowed you can easily increment your size as you go up. And so you can see this movement here is, now I can target maybe $200 worth of profit for, $50 or $75 risk as you slowly increase your size when you become profitable. And so the best way that I have actually found to trade futures is actually looking for reversals on a 1-minute chart. You can trade futures on a 1-minute, 5-minute, or even an hourly chart. Again, it's all about trying not to hold to it overnight and mainly just sticking to day trading. That's really where the power comes in. You can hold something for a couple days, but again, it opens you up to that risk of having those large drops from market closing and then opening up again with news in between. But what I found to be super powerful is literally in the first 60 minutes every morning, I just watch the US stock market open. That's when it's super volatile, has a lot of potential swings like this. And you can see this swing right here in the last, what we're just looking at, that could be a couple $1,000s, right, if you're trading large size. And so you can easily make a strong amount of money trading once you become profitable with this strategy in literally just 60 minutes in a day. It's what I've traded for a while now, and it's literally all I do. And so to walk you through that now, what I do every morning, I literally just come in, I look for key areas of support and resistance, and you can see here the market bounced right here. And so that's why I'm kind of thinking, okay, well, if it comes down here again, I want to see if we'll bounce again. And so that's kind of the first thing that I always look for in this strategy is looking for the market to bounce at a key level. You don't want to just be randomly thinking, okay, well, it'll go here, it'll go there. That's when you start to become reactionary to the market, and you want to actually have a plan and wait for the market to fit that plan. I have realized that over time that that's really the way to become profitable. And the other part of that is just find one strategy and one pattern that works. You don't need to find 10 different strategies and be trying to capture, every move in the market, because like you just saw, when it comes to the sizing and scaling, these numbers in a way can become infinitely huge, right? You can be literally risking $10,000 on a trade and make, $40,000 in 20 minutes. Now, that seems mind-blowing because, when I first started, I was risking literally like $25, $50. But now in this trade right here, I'm risking something like $500. And you'll see the potential can go really fast once you kind of get this in play. And so the next thing I like to look for is you can see the market came down here to this level and it actually broke this downtrend. So that's kind of the second thing I like to look for. When you're looking for reversals, you need to make sure that the downtrend is broken. And so what I've done here is I've kind of confirmed that after this trend was broken. And so it's starting to show some strength, some bullish candlesticks, and I like that for getting in on a trade, betting that the market is going to go higher. Now, kind of the last couple thing I like to look for is I want to see the market kind of start to show kind of a bottoming pattern. Right here, it's basically making higher highs. And so I like this as this candlestick was a really kind of a big bearish candlestick attempting the market to go lower. And it failed here based on these candlesticks. And so I like the idea of saying, hey, I want to get in long above this candlestick right here, betting that the market is going to go higher. And so I put what is called a buy stop order above it. If the price of the market touches this price, put in a market order. I don't care what you fill me at, just get me in the market. And most of the time you can see it literally just fill it at that exact price. But sometimes it can, fill you right here because the market can move pretty fast. But that is the order I like to enter in on most of the time. And you can use a buy limit order that'll get you in below or exactly at that price. But the problem with that is, well, for this example right here, well, the market kind of took off here and you would have felt a lot of FOMO and because you would have missed out on the trade. And you would have had to wait for and hope that the market comes back down and fills you at that price. And so you can see here quickly, just over a couple candlesticks, I'm already up $1,000 on this trade, risking, I think $500 or $600. And so this is where the power comes into play is I'm trading 4 oil futures contracts here, and you can see it's moving in that 0.01 increment, that penny size, compared to the S&P 500 futures that we're just looking at, was actually moving in that quarter of a point size, at 0.25. But you can see here clearly that the money is a lot more. And so for me, my strategy is I like to kind of get in when I see, basically you can easily see here is there's a lot of momentum here. It's starting to slow down by essentially just seeing that the market kind of started to chop here, and then I look for a few key factors to jump in and catch the momentum to the other side. And so I move my stop here to break even, and then as it starts to kind of get pretty accelerated here, I like to use kind of the idea that, hey, okay, I'm gonna give it a little bit of wiggle room, but I am going to move my stop up if it pulls back, because I'm up about $2,000, and you want to let this thing run if it's going to run, but you also you can see like just as it pulled back right here, it can reverse very, very quickly too. And so that's where I really look to manage my trades. But again, that's come with a lot of practice and experience trading this. My target here, you can see now that we're getting up to here, you can see we're kind of in a support level that I've drawn from previously in the chart, and that's where I'm going to expect things to slow down. So you can see I've moved my stop loss up here. It's we're up a lot more money now, and this is where kind of the power comes into play of using technical analysis with futures. Is you have that leverage and you have that ease of getting in and out of the market, but you also have the simplicity of you're not having to deal with the complexity of options and other factors that come into play with other assets. And so just to close this out, I'm not going to go into my strategy too much here. I have a lot more videos on that, but I pretty much get knocked out right there. So no matter how you're planning to start trading, even if you're planning to start prop firm trading, I highly recommend demo trading first. The fees for prop firm trading can be really expensive if you're not able to be consistently profitable right away. That's why it's smart to use NinjaTrader first, and once you're more comfortable, then switch over to prop firms. Again, you can check out NinjaTrader in the description or using this QR code. And if you want to just learn more about my strategy I've been talking about here, check out this video right here.
Okay, well, I will try signing up for NinjaTrader because I really like this layout. It looks amazing. It's much more simple than whatever the fuck I'm looking at here. I mean, I understand it, but I like that more. And this is gonna be it for these extra videos. I'll take a break for maybe half an hour, and then I'll record this. And yeah, I'll see you guys later.